This conference will now be recorded.
Okay, everyone, so we're going to start our look at this Core 1 multiple choice question. Before we begin, I'd urge you to take a look at the PDF that you'll find in the link down below. So I'm just going to show you a very quick way to solve a question like this. And by the way, nearly every Core 1 exam I've heard of has one or two of these questions on DTAs. Okay, so first things first, all right, what I did is to get us all started here. I put in the data from the question for the start of the year. So we're given a UCC of 950 and a book value of 900. So that's a cumulative difference. And I say cumulative because that's important, of 50,000, okay? Times 25% because that was a rate in effect up until the start of the year. Okay, so 50,000 times 25% gives you 12,500 as a DTA. Now, why a DTA? Well, the logic is your UCC is higher than your book value by 50. Okay, so that means you have more CCA available to you to take at a future date, which represents a future tax deduction and a future tax benefit over and above the depreciation that you have left. When you wind these assets down to zero, you have 950 of future CCA available and 900 of depreciation. Okay, so it's very important to go balance sheet to balance sheet like this when you're given multiple rates. Okay, so now the next thing we're going to do, okay, we're going to take a look at, we're given CCA and depreciation for the year. Okay, CCA was 120. Okay, so we'll end the year, okay, December 31st, 2020, UCC of 830. Similarly, on our books, we have depreciation of 50. So now that's a cumulative difference of 20. Okay. And over here, let's get to that in a minute here. Okay, times 28%. Now, why 28%? Because this rate was already enacted. So this gives us 20 times 28%. At the end of the year, we have, I apologize here, 5,600 of a DTL. Why a DTL? Well, look at your difference here between your UCC and your book value. Now your UCC is lower than your book value, so you've taken more of your CCA up front. You have less available to take at a future date, so that gives you a DTL. Okay, we're just about done here. Now, okay, so I numbered the steps here, 1 and 2. Okay, as I said in my document, it's very important that you go balance sheet to balance sheet. And from here, now we're able to get our DIT expense for the year. So to go from a 12,500 DTA to a 5,600 DTL, you'll need a DIT expense for the difference. Oh, I apologize. 18,100. Okay. So what I'll do over here is I'll just erase this for a minute and just put these numbers, just make myself a little bit of room on the whiteboard. So let's try a T account here. And I'm a big fan of using T accounts. Because your DTA, DTL your DTA, DTL on your balance sheet can toggle back and forth between an asset and a liability. So number one, we were given 12,500 DTA, and we were given a 5,600 DTL, and this is where you have to end off. So to go from 12,500 to 5,600, what you need over here is 18,100 of a DIT expense, and that's your answer. It's choice B. If you wanted to visualize the journal entry, you could just do it like this. DIT expense, DTA, DTL, and here we go. Okay, so that's pretty much it. I hope you all found this helpful. And once again, just walk yourself through the PDF that's found at the link below. All right, everybody, best of luck, and I'll see you guys at a future video. Take care.